Trying to figure things out here, Mario. You figure there's going to be more split ups, more divorces. You have made your name as Dr. Love, and that's what we always call you.
Joe, thank you. But
companies getting together. Yeah, corporate companies getting together. But sometimes marriages don't work out, but they'll still keep happening, right, Mario?
Corporate lovemaking with private equity, SPACs, and strategic. For example, this week you had a couple of big deals. KKR got involved in buying Cyrus One. You had someone else buying CoreLogic's American Tower. That's going to be a lot more going on a global basis. But the thing that I'm talking about is that the deals that you thought about in the past, Honeywell splitting up, IT&T splitting up, DuPont splitting up, all of a sudden you had an avalanche with IBM, J&J, and you had Dell and VMware, and then you had United Technologies doing their thing, which worked extremely well. Then you had the non-U.S., Case New Holland. Tomorrow they're having a meeting, splitting up. You had Toshiba, three-way split. You had several others like Volkswagen spinning off Traton, their truck business, Daimler doing it. The point is that when the boardrooms of America look at this, when they look at what's going on, you have contagion. They're starting to think of, if we've got a business that's growing at 2% and one that's growing at 10%, and the market's paying only 4 or 5% for our growth rate, why not re-examine how we do it from a tax point of view and what's fair to the shareholders? So that's what's going on. And there's a whole bunch of companies that I like. I like the one Vivendi did as an example. I think the stock now is 11. They spun off Universal Music. That stock is extraordinarily interesting. Grupo Televisa is interesting. Case New Holland. These are the companies that are going through this financial engineering. Some of them, like the IBM KD split off, you have to be patient, Joe. The mechanics of an ETF owning IBM, where they want it in a certain size portfolio, they're going to basically sell the stock. And so you got to figure out, when are they finished selling it, and then do you want to own it?
Well, not every conglomerate in the past that you were talking about, there weren't synergies. A lot of times they were just a collection of assets. Is that the point you're making, that there needs to be some type of symbiotic relationship between the different entities that are in an integrated company?
No, the perception of Wall Street changes, Joe. I started my career as a sell-side analyst in the 1960s, following farm equipment, conglomerates, autos. The conglomerates were put together because there was a business cycle every 4 years. So you wanted to have businesses that smoothed out those cycles by having leading, lagging indicators. And, things change. And today, in a free market system with all the mistakes, look, AT&T, that's a spinoff of Warner Media. I'm not going to get in what Jeff Buick said, but independent of that, that obviously Discovery is going to do extremely well. Zaslav is dancing in the aisles, but at the moment, the stock market is not. And so you have the good and the bad, but you got to allow this to happen. The companies make a lot of mistakes, but they also do extremely well, and the markets change.
Well, investment bankers, they seem to do well either way, and we've seen the PBMs, they need to be owned, they need to be spun off. Is there anything to that CEOs are suckers to when these guys come in from the big Wall Street firms and make a case for something, and then 2 years later they make a case to do a divestiture? But there's fees both ways.
Joe, that's, we're all, I'm more cynical than you are, but independent of that, I have a coin in God we trust, everybody else we verify. Independent of that, Joe, tonight, for example, John Malone and Greg Maffei are coming along. I'm sure they're investment bankers, but these guys come to work every day to make money for the shareholders. When I'm a pension or endowment plan and I'm being told to buy an asset, a PE, put it into a PE, I pay 2 and 20, I have a 10-year lockup. I'm buying stocks that I don't know, or companies that I don't know what they're going to pay, and I don't know what their exit multiples will be. Today you could buy Maffei and Malone and all of their companies, and you can get them at a discount from what they're worth. You don't pay 2 and 20. You pay something. But on the other side of the coin, you don't have to have a lockup. So there are many companies in America with fantastic CEOs that come to work every day, and they're basically better than PE firms. Amatec is an example. Dana, which Carl Icahn is putting his arms around us. Companies like that have very good management. Genuine Parts I've been following for 50 years.
Hey, Mario, you talk about John Malone, and he's somebody who's been so smart about making sure he's looking at tax minimization strategies. That's part of the reason he's done so well. There are so many talks about what may happen with tax strategy in Washington right now. I am sure investors like yourself are kind of looking through all of this and trying to figure out where the next step may be coming in terms of tax changes. Are you doing anything at all in your portfolio to plan or prepare for that?
Great question, Becky. And from that point of view, half of our clients are taxable and half are tax-free. Their 401ks and so on, endowment plans and so on. So we have to also follow a mantra. It's not what we earn percentage-wise, which is great. Like this year, we're way above, I don't want to get into percentages, but they're public. But it's what you keep. So from a corporate point of view, the Congressional Budget Office put out a number a week ago that said we as a country took in for the fiscal year ending October 31st, $372 billion. $372 billion against like $220. With a constant nominal tax rate in the U.S. for depreciation running off pre-2018, tax and earnings, nominal earnings, that's going to be $500 billion. And then on top of that, you have a tax rate of a minimum 15%. So those are a lot of moving parts from an individual. And then, unfortunately, you have sad cases.
So, Mario,
lobbyist 1031 is not changing. Carried interest, which is absurd, is being extended. All you got to do is hold it 5 years. The real estate lobby is paying the politicians. It is what it is. From our point of view as clients, we look at do not take all your gains this year because next year, if you have losses, you can only deduct $3,000. So you have to be practical, and that's what we do every day with a microscope and a telescope. And from the stock market's point of view, Becky, it's, inventories are ballooning because of LIFO, FIFO accounting. They're ballooning because instead of just in time, they're saying, just pay me, I'll pay you any price to get it now. And that working capital, and also we're seeing significant increases in CapEx. But the big question mark for us on the stocks is the multiple, and that's a function of the 10-year bond. And we don't think it's going to stay at 161, where it may have just jumped up last night.
Shepard Smith here. Thanks for watching CNBC on YouTube.